Good evening. This is Duane Lowry from the DPP Grain Desk with the Sunday night outlook for August 7th, 2011. Normally, for a Sunday night outlook, I'd be talking about weather. I'd be talking about Friday's price action. We'd be looking forward at USDA reports and what to expect this week. There'd be a lot of things that we didn't come to a conclusion about how that market should trade on Sunday night. Tonight, none of that's going to make any difference. The focus is all on outside markets. It's all on how much nervousness and panic might be associated with the U.S. receiving its first ever reduction in its credit rating from its AAA rating. Standard & Poor's came out with a lower credit rating for the U.S. late on Friday. There's a lot of controversy to this. Initially, they came out with told the White House, told the Treasury Department they were going to lower the rating, offered the Treasury Department their figures. Treasury Department said, wait a minute, you've got a mistake. It's $2 trillion that you're off by $2 trillion. S&P said, you know what, I think you're right. We did make a mistake, but it doesn't matter. We're going to lower your credit rating anyway. There are three major credit ratings that the market pays attention to. The other two have decided to leave the U.S. credit rating unchanged and issued statements over the weekend saying they do not plan to lower it. That will help to temper some of the influence, the emotional impact as well. That being said, I don't want to completely downplay the significance of this. It is a significant event to have the U.S. credit rating lowered, but in context of immediate impact on prices and markets, maybe the impact is going to be relatively short-lived. The stock market has been down hard for the last few weeks, and a certain amount of this has probably been factored in. By midday Friday, there was already rumors beginning to circulate that a downgrade in the credit rating was imminent. Didn't know if it was going to be Friday night or within a week, but the talk was circulating that it was getting close. Also, during the debt ceiling increase debate, it was also known at that time that if we came up short of that grand bargain that President Obama and Speaker Boehner were originally trying to put together with $4 trillion cuts worth of spending cuts and revenue increases, anything short of that was going to increase the chance that we were going to get a credit rating decline. Standard & Poor's, in their press release on this credit rating decline, made it clear that they were very concerned about the political environment, and in many aspects, the press release that they released was an indictment of our political process more so than about the raw numbers of our debt versus GDP, etc. So that's going to provide our initial direction here tonight. We're going to see everything start lower. There's not going to be a lot of people wanting to sell grains on weakness. Attitudes are pretty friendly. They're looking forward to Thursday's USDA reports, believing that regardless of what figure we get from them, many private individuals and private analysts believe that the final crop size is going to be less than what USDA may come out with for a yield. A lot of people talking about corn yields less than last year. I don't happen to agree with that, but that is a very common and prevailing thought. So look for wheat to start lower in sympathy with outside markets. There's not a lot here for news in wheat. Technical conditions are a little bit vulnerable, so you might see some selling pressures there. But when you look at intermarket spreads, wheat versus corn, wheat's already quite cheap, and I think a case could be made for some short covering here before Thursday's report. As far as corn is concerned, the trade has got such a bullish attitude on that I don't envision many wanting to initiate new short positions despite the economic problems that we may have and the nervousness that may be around. So after an initial bout of weakness and panic, we'll see whether the market's able to recover either tonight or tomorrow as the week progresses going into Thursday's USDA report. And I think the same thing can be said true about beans. Beans have already suffered a fair amount of liquidation over the last several days. That they've been the weakest of any of the ag markets during the last week, and so to some extent, some of that forced liquidation selling that the market was vulnerable to has already occurred, and so you may not find a lot more selling here tonight. So we can start lower, but we may be relatively well supported and hopefully find some stabilizing price action. But that being said, I think there's an important discussion and thought process that needs to go on regarding outside markets and the influence on the grain trade. Forget about the credit rating decline and the short-term panic implications of that. On a bigger picture, we're dealing with a struggling U.S. economy, a struggling global economy, problems in Europe, and all of this translates into probably the opposite of inflation, and probably the opposite of what has been driving ownership in commodity markets for the last couple of years, looking for inflationary tendencies. I don't think we're dealing with an inflation situation. Whether we're dealing with deflation or not is a debate, but we're dealing with slow growth. If we have slowed economic activity, the appetite and the enticement for investors to move into the commodity markets is going to be lessened. As fewer of that money comes into commodities, you have less energy to not only propel prices higher, but to even sustain current levels. If the marketplace finds that between now and harvest, the current trade estimates for national yields in corn and beans maybe have been overly ratcheted down, and fears of the impact of heat over the last couple of weeks maybe has been exaggerated in parts of the Midwest, and and we find out that we have adequate supplies. They might be tight, but if we find out we have adequate supplies, we may have an economic base here that can't sustain these prices. And as we look forward to trying to assess producers' risk at current levels, we have to say we have a fair amount of risk. When we consider how much the market has talked about heat, how bullish the attitudes are, how saturated the agriculture markets have been with speculative link, and yet we are stagnating in prices here. If we see these prices begin to roll over, I think we're dealing with a situation where we could have a prolonged period of weakening profitability in agriculture. At $7 corn, you could have $5 corn and still be well supported, but it would be a significant change in your profitability from what's currently being offered. So rather than get caught up in the short-term impact of the credit rating being declined, I think that we should look at the economic outlook and be concerned that a slow economy that lacks inflationary pressures may not be good for commodity markets in general, including agriculture markets, especially if we find out that we have adequate supplies. So from that standpoint, I think it's time for producers to again look at longer-term projections, look at longer-term profitability, try to secure profits on the 2011 crop, consider expanding sales in both 2012, and possibly even looking at price protection strategies to take you beyond that. So I think there's important things to discuss here, so don't get caught up only in the short-term implications of a credit rating. Make sure you look at DPP and look at your deferred bids, look at your profitability, and see if some of these sales work for you. For DPP, this has been Duane Lowry. Thank you.